Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today we're diving into a Form 8K filing. It's like a corporate uh-oh report. Something important happened and the company had to tell the Securities and Exchange Commission, which is like the government's business watchdog. Think big money moves, like a company taking out a loan to hopefully make things better. This report is from zSpace, a company with the stock ticker zSPC. The filing is dated April 10, 2025. Something must have happened on that day. So let's find out what. The big news here is a senior secured convertible note financing. That's a fancy way of saying they took out a loan. It's like when you need money and you go to the bank and promise to pay it back, usually with interest. zSpace made a deal with an investor. The investor gave zSpace almost $14 million, but there's a catch. This isn't just any loan, it's a convertible note. That means the investor has the option to turn the loan into shares of zSpace stock. It's like saying, instead of you paying me back in cash, I'll take a piece of your company. There's also the possibility of another $7.5 million loan later on. So all in, the investor might pump in over $21 million into the company. zSpace says they'll use this money to pay off some old debts. It's like cleaning up the financial mess and using the rest to keep the business running smoothly. Now, let's talk about this loan a little more. The loan earns 6% interest each year. That means zSpace has to pay back the money they borrowed, plus an extra 6% on top of that. This loan has a deadline or maturity date of April 2027. This is a secured loan, so if zSpace can't pay back the money, the investor gets first dibs on the company's stuff, all its property, including the technology it owns. Here's where things get interesting. The investor can convert the loan into stock at a price of about 12.39 a share. If the stock price goes way up, the investor can convert the loan into shares and make a lot of money. There's also a minimum price built in of $1.98 per share, which helps the investor. This is designed to protect the investor if the stock price tanks. If something bad happens and zSpace can't meet its promises, it's called an event of default. In this case, the investor can cash out even faster for even more money. Starting 90 days after this deal, zSpace has to start paying back over $665,000 every month. They can pay with cash or, if certain conditions are met, with shares of their stock. So the company will start doing that months after the deal closed. If zSpace gets bought out by another company, there is another interesting situation. The investor can demand a big payout, making sure they get a good return on their investment. The company also signed what's called a registration rights agreement. This is all about making it easier for the investor to sell their shares if they convert the loan. Some of zSpace's major shareholders have agreed to a voting agreement. This means they'll vote in favor of things that help the loan deal go through. The investor also gets a security agreement and an intellectual property security agreement. This gives the investor even more control over zSpace's assets if things go wrong. Our Space used the money from this new loan to pay off some old loans from a company called Etra Ventures, so they basically swapped one debt for another. Our Space also made some changes to its existing loan agreements with another company called Visa Investments Limited. The company managed to delay these payments for the coming years. The interest rate with Visa Investments was also lowered. They also signed something called an intercreditor agreement. This basically says that the new investor gets paid back before Visa does. Now let's dig a little deeper and see what else we can find. The actual contracts for this deal are attached to this report, but these are lengthy legal documents. Now, what does all of this mean? This is a complicated financial move, but here's the basic story. zSpace needed money, so it took out a loan. The loan is secured by pretty much everything the company owns, and the investor has the potential to make a lot of money if zSpace's stock price goes up. It's a risky move for zSpace, but it could also be a smart way to get the cash they need to grow their business. The company is trying to clean up its balance sheet and secure its future. The company swapped debts and is hoping for the best. What are the takeaways here? First, zSpace is clearly a company that's facing some financial challenges. They wouldn't be taking out these loans if they didn't need the money. Second, this deal is very favorable to the investor. They're getting a high interest rate, a lot of security, and the potential to make a big profit if zSpace's stock price goes up. Ultimately, the future of zSpace is uncertain. If they can turn their business around, this loan could be a great thing for them. But if they can't, they could end up losing control of their company. Thanks for watching Corporate Decoder. I hope you learned something today. If you did, please like this video and subscribe to my channel for more deep dives into the world of corporate finance. Let me know in the comments what company I should decode next.